It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Sydney's housing property market is facing a major generational shift, with new data showing home ownership has fallen to levels not seen for decades. Rising property prices, limited housing supply and increasing rental demands, yes, these are all the culprits that are changing the way that younger Australians are approaching the housing property market in this moment in time. So is Sydney becoming a city where renting long term just is a fact of life? It becomes the reality for more people. Yes, home ownership in Sydney, it has fallen to its lowest level since the 1950s. Is this, do you think, a temporary affordability challenge, or are we seeing a long-term structural change in how Aussies access property? What do you think?
Yeah, good morning, Craig. Well, I think Sydney's home ownership rate is basically putting a number on what people are already feeling. It's taking longer to buy, it's costing more to buy, and renting has become much longer stop than most households would expect in the past. We have seen that, these numbers from KPMG do show that ownership rate fell from 2001 to 2025. Over that period of time, there are a few factors that have been put in play here. We are seeing higher interest rates. We are seeing more cost of living pressures. We are seeing affordability deteriorate over that time. And that has all come into play and seen less people be able to buy, less first home buyers, less younger families be able to purchase their first home.
The age bracket of people getting into their first homes, it is getting older and older because that is being dictated by the current set of conditions that first home buyers are in. Government support programs, they have helped some buyers enter the market, but if enough homes are not being built to match population growth, which is a root cause to all of this, how can affordability improve? So many people are asking that question. Or will this be a case of more Aussies continuing to delay home ownership?
Yeah, you're right there, Craig. The biggest issue is supply. Rates and government incentives and programs will change and move up and down over time. But unless we are building enough homes to keep pace with population growth, affordability stays under pressure, not just from purchasing point of view, but also from rents and rental growth as well. Vacancy rates will remain low, rental pressure will increase, rental affordability will deteriorate, and that means saving a deposit to purchase a home becomes harder and harder.
We were talking just on Saturday, this next RBA meeting is going to be very interesting. Higher interest rates, they have added another layer of difficulty for buyers, particularly those trying to save for this wretched deposit while paying, rising rents. If you are an aspiring homeowner, the challenge isn't just securing the finance, but also having enough time and financial breathing room to enter the market. It's kind of like one step forward, half a dozen back.
Yeah, that's right, Craig. The latest unemployment number shows that the labour market is quite tight, and combine that with the ongoing inflation pressures and the geopolitical conflicts that's happening overseas, there's no certainty that interest rates are going to be coming down anytime soon, and in fact, more likely going up in the next couple of months. So there is still some pressure on property markets. It is going to be harder for those to save that are willing to save for a deposit. And it's also going to put pressure on rental markets, again, extending that time to save out a little bit more, because we're just not seeing the supply in the market at the moment. We're not seeing the buyer demand in the market for the construction of new developments to start as well.
Now, this PropTrack report, Veronica, as I say, with fewer buyers competing and investor activity easing, could this be the window that many people have been waiting for? What do you think?
Well, I've been in real estate now for 26 years, and every time there's a window of opportunity, everybody predominantly sits on their hands and doesn't take advantage of it. So yes, there's a window of opportunity, but it's a little bit more complex than that, particularly for first home buyers. As you probably remember, I've got a course for first home buyers. We have a lot of people in our mentoring program, and it's interesting how the confidence goes out of the market when prices start falling. And it's what everyone complains about when prices are rising. They just want a break. They want prices to fall. But when prices fall, they go, oh, I don't want to buy now. I want to wait. And so trying to get people to have the confidence to act when the opportunities are there, that is always an interesting challenge. It's just human behaviour at its finest.
Human nature in all of this is let's just wait a little bit longer. And that is what you're talking about. That is the hardest probably piece in a softer market to educate people on.
Particularly with first home buyers, because, in Australia, a lot are taking advantage of the 5% deposit scheme. And so that means that the needle doesn't have to move far for them to go into negative equity. So they're sort of thinking, well, God, if I buy with only a 5% deposit plus paying costs, I could end up with owing the bank more money than the property's worth. That's very real risk. And it doesn't make you feel good. You buy a property and it goes backwards in value. So it's a difficult one to get over. I tell you, the type of buyer, though, that in an advantage or a particular advantage other than first home buyers in a falling market are the upgraders. Assuming all things are equal, you sell a property, you might take a bit of a hit, and the property you buy or you upgrade to presumably takes a bigger hit. That's sort of a little bit theoretical, but it does play out in many cases. And so the transaction cost is smaller than it would be in a rising market, but people don't feel as good about selling their property for less than they might have potentially got it for it previously. So that's a difficult one. But at the same time, discretionary sellers stop listing their properties. So what we find as buyer's agents, always remarkable that in a buyer's market, when we should be in the box seat and be able to get whatever deals we want, yeehaw, but it doesn't work that way because not every vendor is prepared to bring their property to market under these conditions. They will wait too. So if the buyers are waiting, the vendors are waiting, we end up in a bit of a standoff.
What do you think about the Sydney auction market? Obviously, you're trading in this space. Do you think that this is the beginning of a even more cautious phase in the market?
Well, look, I've seen this happen numerous times in my career. When the market cops a few shocks, as we have done, compounded, we've had a number of shocks this year, but also then we had the budget. So that seems to have taken the wind out of everybody's sails. We go through this period of it's a hiatus, if you like, or it's a situation where not much happens. So clearance rates will fall. That exacerbates the problem because, of course, anybody who's wanting to sell thinks, well, I'm not going to put my property on the market. So you've got less properties to look at. Anyone who's going to buy thinks, oh, it's going to fall more, so I should wait and actually buy at the bottom. And so you've got all this sort of complete inactivity and that just feeds more negativity. But there always comes a point where people just seem to collectively say, I'm going to get on with my life. I have to get on with my life. I still need to buy a home. I still need to upgrade. I still need to downsize. I still need to move states for a job or whatever it is that is driving them. I'm still getting divorced. Whatever is driving the need to change properties, that will still happen. Life doesn't actually stop because the property market it goes into a down cycle. We just wait for life to get in the way and things will start moving again.
How are you finding, negotiating with the vendors or the real estate agents? Of course, go back 5 years ago, it was a completely different playing field. How much of the chasing you at the moment by these agents saying, oh, Veronica, I've got one here. Oh, here's another one for you. That must be a lot more happening these days than what it was.
That's how we know the market's about to turn. We knew that agents were seeing a lot less attention from buyers some months ago when all of a sudden, our email feeds are lighting up and our phones lighting up with agents proactively offering us access to properties. Do you have a buyer for this? Whereas we've been chasing them actively for a number of years. So yeah, that tide has turned. They're struggling to get listings as well. So often they will talk to us about properties where they've been speaking to the owners. The owners aren't necessarily willing to commit to putting their property on the market currently, which is fair enough. We do a lot of vendor advocacy as well, and we have very good conversations with our potential vendors around how motivated are you to sell right now? What are your real reasons for selling now, and how ready are you to meet the market should the market not deliver what you're hoping for? And these are really important questions to have with owners before they put their property on the market. But a lot of agents are out there trying to convince owners to go on the market because, of course, their volumes are down and they're hurting financially. And they will be talking to us, and no doubt other buyers agents, around these quality listings often that they're potentially getting. And they're wanting to work out if we can introduce some buyers beforehand and maybe negotiate a deal.
Ready to take your real estate knowledge to the next level? So are we.
Many first home buyers right now, Margaret, are choosing to wait before they pull the trigger. So waiting for better opportunities versus delaying buying and then ultimately paying more in the long run.
First home buyers are well aware that they can be trapped into a cycle of negative equity, and having no property at all is better than suddenly seeing your hard-earned money swallowed up in, first of all, that stamp duty we talked about, but second of all, in property prices sliding a little bit backward and then giving them a negative equity position. What's the point in saving really hard for 5 to 7 years to get into a home because you don't want to be paying rent to a landlord anymore, only to see you in a position where you actually have less than you had when you went in? It is a better proposition to pay the money to the landlord than it is to actually have it gone and disappear into the ether in the form of negative equity. And I think that's what's happening with our first home buyers. People are largely a lot more informed about property these days than they were many years ago. And I recall buying my first home, and I can't say that I even had a clue what the word equity meant. I didn't even think about that. I just knew that my dad said, don't pay rent, buy a property, and we did. And we bought that first property that we've talked about many times out in Cabramatta, a 1-bedroom unit. I know how much I paid each month on that mortgage. I had no idea what interest rate I was paying. I had no idea whether or not the $2,000 that I brought into it at the time and $2,000 borrowed off my dad, I had no idea what that all meant. I just knew that I got into a home. But I think these days the first home buyers, because there's so much information out there, we have social media, we have every man and his dog a property expert putting up podcasts on, and that's no disrespect to you, Craig, because you are a property expert, but every man and his dog has a reel on TikTok with something about property, and first home buyers far more informed than they used to be. And the reason they're getting scared at the moment is because they know very well what it means to get into a property, have your equity disappear, and to be worse off than if they just stayed renting.
Yeah, it's funny how you know the stats on your first property. I do as well. You know all the ins and outs around the first property. Can you, if you're listening to us right now, can you remember exactly how much you paid, what those monthly repayments were, and how much money you made when you turned that property over? Some very good advice from your dad. Don't pay rent. Get into the property market. Now, since we're talking about first-home buyers, let's talk about the investors, because they, at the moment, also have this very cautious approach. If the interest rates stabilise, could investor demand return quickly and place renewed upward pressure on the Sydney property prices, particularly in affordable suburbs? What do you think with regard to that piece of the equation?
I think if investors return, they're more likely to return to more affordable markets that may not include any suburbs in Sydney, because let's face it, even those outer, more affordable suburbs might seem more affordable to people who are in Sydney, but to people in Perth and Adelaide and other areas where their outer areas really are more affordable, they don't seem to see it that way. And I think investors are becoming more interested in those markets. We see Hobart and Darwin not having a receding property price yet, because both of those markets are still considered affordable in the big grand scheme of things. First of all, investors got spooked when they heard about the budget. Second of all, they're trying to get their head around what it means, and they're still doing that. And they're still confused, and they believe that what taking away negative gearing means is that there are no tax deductions available to investors, and if they buy a property, they're going to have a giant impost with no access to tax relief, when in fact the realities are you still have access to tax relief, but only insofar as it can be offset against the rental income of that property. So where previously any additional costs that were more than you got for rent were able to be offset against your own income, they are no longer allowed to be. If interest rates stabilise and rents keep rising a little bit, then for an investor, they may well be able to buy a property where the amount of money coming in might even cover the interest on the loan and the other expenses, or come close to.
Are you considering right now taking your property to auction in Melbourne or Sydney? And if so, because of these lower auction clearance rates, how nervous are you feeling? Or do you feel that your property is likely to buck against in the auction space? Let's just pick this up because, these clearance rates are down.
Yeah, very much so. I probably have a bit of a different perspective to the wider marketplace in that we're looking comparatively at auction clearance rates and private treaty success rates for a comparable time period. Call it 30 days, which is a typical listing time for an auction, 4 weeks. The average private treaty success rate is somewhere sitting around 20 to 23% for the major capitals on the eastern seaboard, whereas the auction clearance rates have been hovering in that 45 to low 50 percentiles. So realistically, auctions are still a better way to sell. Yes, they are down from what they were this time last year, but at the same time, it is one step in the process to bring buyer and seller together, not so much focusing on selling under the hammer on the day.
While public auction competition has weakened, some properties are still selling through private negotiations after the auction. How big is that piece to the pie at the moment?
Quite a large portion of the pie. So we're finding that a lot of properties are selling within 7 days post the auction result, because up until auction day, it is all talk. It's talk from buyers, it's talk from vendors. People vote with their feet by turning up to auction and with their actions of bidding at auction. And a vendor can't hide from their reserve price at that point in time. And so actually understanding where the marketplace sits gives both sides, buyer and seller, the ability to understand, process that information, educate themselves, and hopefully align together to get a deal done. Don't get me wrong, there are definitely properties that are sitting on the market and becoming stale, that are sitting on the market 3, 4, 5 weeks post-auction. And unless you're heavily reducing price, you're typically going to sit there for a fairly long time at the moment.
We connect you to the best real estate information across Australia. The Real Estate Podcast.